Hi, I'm Karen from 24 Hour Bookkeeper. Why should you care about understanding your financial reports? We've all said it. We're not in business because the sky is blue. As much as most dread reading their financial reports, likely because they're hard to understand, it is super important to start making that part of your management process. If you had the opportunity to track financial patterns and get real-time information, you would probably be more profitable and be able to make appropriate changes as necessary. There are 4 main financial reports that you should be reviewing regularly. It's the profit and loss, the balance sheet, accounts receivable, and accounts payable reports. These reports are found in your accounting software, not necessarily your project management software. I'm going to give you a quick rundown on each one. Let's start with the profit and loss report. This report is actually quite simple and tells you how much money you brought in, referred to as revenue, minus how much money you've spent, cost of goods and overhead expenses, and tells you what you have left over, which is your net profit or loss. Let's see what one looks like. Here's an example of a profit and loss report. It does go by other names such as income statement or P&L. For your construction business, there's likely 3 areas that you will have to manage on this report. Let's start with revenue. Your revenue, also referred to as sales, is the money you have received from your services. The next thing is your cost of goods, and these are direct costs to your sales or your revenue. You'll want to record project costs, which are directly related to your revenue, as a cost of goods item. Examples of cost of goods would be materials, direct labor, or subcontractor costs. Then you've got overhead expenses, which shows you what it costs to run your business. These overhead expenses are not directly related to the projects. You'll notice at the bottom of the report, there's either a net profit or loss. This means you either made money or you lost money. I'm not going to go too deep into the accounting hole, but the best way to view your report is an accrual basis. This includes transactions that have been recorded, such as bills and invoices, but haven't yet been paid. Let's talk about the balance sheet. We've heard about it, and it looks awfully complicated, and I will say it typically is, unless you're comfortable with it. This report shows you the financial health of your business at any given time. It'll tell you how much money you have, what value you have in assets, what you owe on loans and credit cards, and how much you have in equity accounts. Let's take a look at a balance sheet report. Here's an example of a balance sheet for a construction company. You've got your cash accounts, which are your savings and checking accounts, in addition to any petty cash you might have on hand. Next, we want to make sure we record our assets, which are items of value that we have purchased, like vehicles, equipment, or buildings. You also would be putting things like work in progress accounts as asset accounts. I'm not going to go into work in progress, but you can check out another video for more information on that. You might also have items here such as employee advances and accounts receivable. If you don't see accounts receivable on your report and you know you have some customer balances, it's likely because you're not viewing the report in accrual basis. Next, let's skip down to the liabilities, which are monies you owe. Examples would be payroll liabilities, accounts payable, health insurance, and credit cards. Let's scroll down to the equity accounts. Equity accounts typically represent ownership of a business or payments to business owners that were either contributed or distributed. So here, you might see shareholder distributions and contributions, as well as retained earnings. Again, I'm not going to go into the detail of what some of these accounts mean, so check out another video for that. It's crucial that you look at these 2 reports at least once a month. I wouldn't recommend looking at them sooner unless you're tracking certain numbers. The reason I say monthly is because you can reconcile your accounts and verify that the transactions that make up your numbers are real. During reconciliation, you catch any duplicates or any issues that might have occurred throughout the month. And lastly, I'm going to jump into accounts receivable and accounts payable. Accounts receivable reports show you a list of your customers and how much money they owe you. Here's an example of a receivables report. This report shows your customers on the left, showing a balance due in one of 5 columns. These columns represent if that amount is either current, 30, 60, or 90 plus days overdue. If you see an amount in the 30-day column, that means that the invoice is 30 days overdue past the date that was noted on the invoice. I would be checking this report regularly as cash is king, and this is the best way to find out who owes you money. Hard to bring in money when you don't know who's overdue. And lastly, let's talk about accounts payable. This report lists how much money you owe to each vendor or subcontractor. It reflects what you owe for both job-related and overhead costs. You'll see the list of your vendors on the left side, and similar to the receivables report, find the 5 columns showing the amounts due and if they are either current or overdue. Remember, this is you and what you owe your vendors. Thanks for watching this video. For more videos, make sure to click subscribe. You can also find more info on financial management by going to our website at 24hourbookkeeper.com, which can be found in the comments. See ya!